Good evening, guys, and then welcome to yet another session. Like we normally do it, free sessions on Saturdays and then on Sundays, mostly on the weekends, actually. So normal to pick a topic and then discuss. And then today, I think I want to today what we're going to be discussing is risk management. And I think why I decided to pick risk management is because I think a while ago I took a trade and then I think overconfidence made me to like over risk. I think risk all my account on the trade, and then I learned a lot from it. And then I think it's risk management is just like discipline. It's not a one act something. It's not something that you just, it's not like a button that you just flip and then you always have risk management. It's something that we have to constantly remind ourselves as traders that we're supposed to abide by. Do you understand? So we're going to look at it proper, and then we're going to see how we can apply proper risk management on our day-to-day trading, and then how we basically know what amounts to like risk. Do you understand? So first of all, I want to like apologize again for starting late. We're supposed to start initially by 7, but then unforeseen circumstances. So so first of all, what's risk management? If you look at the concept of risk management, one sec, let me write it at the top of my chart here. If you look at the concept of risk management, if you look at the concept of risk management, what we're just trying to do is more or less try to like manage our accounts. Do you understand? In a sense that we're trying to manage our equity. We're more or less trying to break our accounts into chunks and then risk them per trade. Do you understand? So that whenever we're having losing trades, all our accounts don't go. And then whenever we're having winning trades, we more or less make a lot of money to cover for losses. Do you understand? So for me, I feel it's self-explanatory, but then we're just trying to like, since Forex trading is a probabilities industry, it's a probabilities game, risk management is there to help us when we have those losing streaks and then more or less give us an edge when we have those winning streaks. I don't know if you guys get it. Do you get? So if you observe the market, or if you observe one thing with trading, is that one thing that is guaranteed is you would always have wins and losses. Do you understand? And it's another thing I want to emphasize. You get to see a lot of people say that, oh, you people are guaranteeing one thing that is guaranteed is losses. At the same time, one thing that is guaranteed is wins also. Do you get? So whenever you have a loss, how do you secure your account so that you don't lose everything? Do you understand? Because that thing is very, very important. It's not as if profitable traders are not taking losses in the market. They are taking losses. And I used to say this thing that if any trader tells you that they don't take a loss, it's a lie.
Which
You
kind?
understand? So how how are profitable traders taking losses and then they are not blowing their accounts? Why is it that it's only you that if you take one loss, all your account has gone? You make $100, $200, $300, and then you take one loss, $1,000 have gone. Do you understand? All these things are things that traders go through, especially beginner traders. And why we go through that, it's because of the absence of risk management. Do you understand? Now, as we're looking at this risk management proper, I want us to get this whole idea. Whatever account you're trading, I want you to start looking at it from that perspective of it being 100%. So 100% of $1,000 is like, sorry, 1% of $1,000 is going to be the same 1%. If you look at it from the perspective of 100% of your accounts, it's still going to be the same thing with $100 accounts. The only thing that is going to change is the monetary value. Do you understand? So whatever account you're trading, look at it like 100%. Do you understand? So if you're trading an account, instead of saying, "Oh, I have a $10,000 account," just look at it that it's $100. So sorry, it's 100%. Inside this 100%, you'd decide you decide to be risking, okay, a certain percentage per trade. Are you guys getting the idea? That's the first thing I want you guys to have at the back of your mind. Now, another thing I want us to understand is, first of all, is the whole concept of risk reward. Do you get? So let's look at risk reward. So whenever you take a trade, sorry, whenever you're plotting like a trade on MetaTrader, you would always use this whole stuff, this whole short position or long position, and you always see this whole thing, risk reward ratio. Now, what's this risk reward ratio? This risk reward ratio is more or less your stop loss compared to your take profits, and it's very, very important. Do you get? So if you look at this risk reward ratio now, it's 2.66. What this means is if I carry this stop loss now and put inside this my take profits here, it will enter at least 2.66 times. That's roughly 2.5 times. And if you use your ISF and see the thing, you see that this thing can enter here at least 2 times. Do you understand? That's the first thing I want us to understand. The next thing is the whole or how this risk reward more or less affects us as traders. Do you get? So when it comes to the whole effect, if I'm having, let's say, if I'm using this whole risk reward of 3 for every trade, it means that if I risk $100, that's if I take a trade and if price tap my stop loss and I'm losing $100 and I have a risk reward of 3, what that means is if price hits my take profit, I'm going to make times 3 of that since this stop loss can enter here 3 times. Are you guys following? That's how risk management, that's how risk reward more or less affects us or plays in our trading. So whatever you're risking, you're going to get at least times 3 of that. So if I have a risk reward of 4, or let's say a risk reward of 5, what that means is if I risk $100 for this, that's if I take a stop and then if price hits my stop loss and I lose $100, by the time it hits my take profit, I'm going to make times 5 of it. Are you guys getting the idea? Please, if you guys are following, you can just drop an emoji in the chat section. Let me know if you guys are able to. Okay, good. And please, yeah, another thing I'll say is, sorry, the whole session is scattered. Do you get? I was on the road and then I just got home and then I said we must do it. Do you get? We must do it, and that's why I didn't want to postpone it again. You understand? So forgive me if the whole thing is looking scattered, but then just make sure that you're taking home the points. You understand? Whatever thing we're picking to learn, just make sure that you're following. If you don't understand any concepts, just call me back so that I'll more or less explain it. Now, another concept I would like us to look at is the whole idea of a stop loss. Now, this one is more or less hard for beginner traders, but then the whole idea of a stop loss now is more or less where you want to close your trading losses. Why? Because the setup has invalidated. So whatever trade you're taking, whether buy or sell, there's a potential that price will not actually respect that whole trade you're taking. So let's say you're looking at buying and then price should go up. There's a potential that price might not go up. So at what point does that trade invalidate? That's where you drop your stop loss. Do you understand? So once price hits your stop loss, a certain amount is going to be cut from your account. Do you understand? So most times you get to see that people don't put stop loss and then their whole account is blown. So it's good that as a trader, every trade you're taking, you put a stop loss. Now, the next concept I want us to talk about is your lot. Now, your lot size is more or less just the amount or quantity you're looking to trade. Now, it's more or less like walking
Please,
into buy
can you
something and
mute
then they ask you how
everybody?
many.
People's mics are.
Do you understand? They ask you how many. Now, that's how many they are specifying in trading is more or less like lot size. So it's your lot size that determines how much you're going to be making or losing as price is going up or down. So if I have a 10 pip stop loss and I use a lot size of like 1, is that lot size that is going to determine what amount will be deducted from my account once price hits my stop loss. Do you understand? So if I use a small lot size, by the time price hits my stop loss, it's going to be a small amount that is going to be deducted. If I use a big lot size, by the time price hits my stop loss, it's a big amount that is going to be deducted. Do you understand? So we have gotten all these concepts here. Another thing now I want us to talk about is the whole idea of, okay, I have an account. Do you understand? And then I want to keep my risk uniform. How do I do it? Just remember, I told you guys that we're looking at this thing from an idea of percentages. Do you get? One problem we get to see is that you see people taking trades and then they are risking, let's say one lot size, one lot size. But then you look at their whole account, and then on one trade, they lost $10. The other one they lost 20. The other one they lost 30. The other one they lost 100. When they now make, now you see that they just made $5. Do you understand? So how do we keep a uniform risk that, let's say on an account I'm trading every trade price is hitting it, and then I'm just losing $100. Mind you, your stop loss for every setup might be different. Do you understand? And this is another thing I want you guys to know. If you look at your trades, you might decide to take, let's say you might decide to take a buy here. You might decide to take a buy here, and then you drop your stop loss down here, and then your stop loss is 14.9 pips. Maybe the previous one that you took was around here, you bought around here where price started pushing up, and then you drop your stop loss just slightly, same thing, slightly below, and you see that this one, the stop loss is 10 pips. So how do you keep a uniform risk? Do you understand? How do I make sure that this one, if price hits my stop loss, is minus 100? This one, if price hits my stop loss, is minus 100. I cannot force, let's say I cannot drag the stop loss and then drop somewhere and then force it to hit it and then be minus 100. Do you understand? I have to follow the parameters of the strategy. Do you get? So in this case, what we need to do now is use the right lot size. So I need to use a lot size that once price hits my stop loss, I'm going to lose $100 here. I need to use a lot size that if price hits my stop loss here, I'm still going to use $100. So how do I come up with that lot size? And the answer is with your risk calculators. Do you understand? Now, I always recommend two risk calculators, either Stino or Nash Markets. Stino or Nash Markets. Stino. Nash Markets. And then please hope I'm not rushing. Please hope I'm not rushing the session because I feel like I'm rushing to a certain level.
No, you are not rushing, sir. You are not rushing.
Yeah. Now hunger cause I'm very, very hungry. I forgot I'm recording this thing for YouTube.
Still no stone, I beg, which one?
And now still
Stino.
a mistake.
Mm-hmm.
Nash Markets. Do you get? So what these things do for you is that you're more or less asking them, okay, with my stop loss of so and so pips, what lot size will I use to risk a certain amount? Do you understand? And that's what we're going to be looking at. So first of all, we'll look at, like I said, we'll look at Stino, then we'll look at Nash Market. Now, another thing before we get in here, Stino is paid. It's $14 a year. And then Nash Market is free. I already know which one you guys will be leaning towards. But then Stino has its own advantages. And Nash Market still have its own advantages. So we're going to dive into it. Let me share my phone screen. Hmm. Can you guys see my phone screen?
Yes, sir.
Okay, good. So we'll start with Nash Markets, but then before we get into that, let's go to Trading View. So currently price is at this level here, and then we decide to take a buy here. Do you understand? Our stop loss is more or less 14.6 pips. Take profit is 23.2 pips. So now let's go to Nash Markets. So if you look at Nash Markets, the first thing we have here is we have account balance, leverage, risk percent, risk amount, select instruments, short, long, all that. Yeah. First thing you need to put is your account balance. So let's say we're trading an account of $500. Now, don't touch the leverage. Always leave the leverage at 500. That's the highest one. So don't touch it. Always leave it at 500. The next thing is your risk amount. Now you can either put the risk amount or the risk percent. So let's say we want to risk like 25% of $500. Do you get 25%? I don't know how much 25% is, but then instead of putting amounts, come to percent and then put 25. You see that it has calculated the amount for us, which is $125. Are you guys seeing this?
Yes, sir.
Good. The next thing we need to do is select instrument. That select the currency pair we want to trade. So in this case, it's AUD USD. So I would search for AUD USD. Click on it. And then it has given us the current price of AUD USD. Don't touch it. The next thing we need to specify is whether it's a buy or a sell. So since it's a buy, we'll click on long. And then now we'll put our stop loss in pips. How many pips is our stop loss? 14.6 pips. And then take profit is 23.2. So you see, you have stop loss price, stop loss pips, stop loss percent. So put stop loss in pips, which is 14.6, 14.6. And then take profit is 23.2. When you finish putting it, you click on calculate. So now it has given us all the information on the trade. So you have instrument, ADS, the asset class, Forex, direction, long. Now, the important one here is this position size. That's the lot size we need to use, which is 0.85. Now, if you use this 0.85 lot size, if price touch your stop loss, what you lose is $125. And if price tap your take profit, what you be making is 198. Do you guys understand? So that's just the whole thing with it. You see that the lot size you need to use now is 0.85. You go to MetaTrader, input 0.85, put your stop loss, put your take profit. Are you guys getting the idea?
Yes, sir.
Good. So now let's look at how to use Steno instead. Oh shit, my Steno don't expire.
What's the name?
Steno, my Steno has expired. I don't even know. Ah shit, I need to subscribe it. But then I think I have a video on how to use Steno. It's on my YouTube page. Let me see. Let me share my PC screen and then show you guys the video. So you guys can just go back and then watch it. I'll subscribe my Steno. So maybe on Monday I'll subscribe it. Take my card as expired self. So let me go to my YouTube. There was this session we did on risk management that I think I spoke about Steno extensively. YouTube Studio. I know YouTube Studio back. Video channel. Yeah, so it's this video on risk management. So if you want to look at how you can use Steno, you can just watch the video on risk management. Do you guys understand?
Yes, boss. Yes, boss.
Yeah.
Yes, sir.
Oh, Grant, now you be that. So now, another thing I want us to more or less get before we call it a day is, how do you know what amount to risk? There's this saying I got from one of the best traders I know. It's like one of the best because I learned a lot from him. He said that whenever you take a trade and then you're feeling anxious or you're feeling uncomfortable, the reason might be one of these two things. First, you don't trust the strategy, or secondly, you're risking more than what you're willing to lose. Now, if you have a very good strategy that I've seen that have given you wins a lot, and then you still take a trade and you're feeling uneasy, you're feeling like, oh, should I go out? Should I stay? It's because you've risked more than what you can afford to lose. So cut down the risk. So let's say you have like a $1,000 account and you risk $100 per trade. If you're not, if you're thinking that, oh, if price hit this stop loss now, I go lose $100, and I know if you afford to lose that $100, close the trade, cut down the risk to maybe $50 or $20. Do you understand? That's like the natural way to know what to risk. The second one now is based off of how many trades you're taking. a day or a week. Do you understand? This one will apply to guys that are doing prop firms a lot. Because one thing with prop firms is they are giving you an overall amount that you can risk and then a daily amount that you can risk. So let's say they said daily drawdown is 6%. And then in a day, you used to get like 7 trades because you're trading multiple currency pairs. If you decide to go and be risking 2% per trade, you see that if you take like one, two, three losses, you've already lost 6%. Do you understand? Then you have 4 more to go. What if it's those four that would be there to Abi would come and then give you profits? Do you understand? So if you see that you take a lot of trades within a day, then cut down your risk. Do you understand? Now, if you're somebody that I think someone like me that has traded for a while and then I know what my setup looks like, sometimes I don't trade in a week. Sometimes I take just 1 or 2 trades a week. Now, if you're that type of person and then you're risking like 0.5% of your account, you see that 1 month to pass, you have not even made up to 2% on that account or 4% on that account. Do you understand? And then if you have a target of like 10% to pass a certain phase, you see that you will not be able to pass it. So in that case, now you need to up your risk. Do you get? So the basic formula there is that if you're taking more trades, if you have like a higher frequency of trades, then cut down your risk. But then if you have like a lower frequency of trades, then increase your risk. Do you understand? So it's not increase so that you come and be doing anyhow, but then increase so that you can make a substantial amount on every trade. Do you understand? Do you guys get the idea? Please, if you're with me, just drop an emoji in the comment section. What's the name of this position size calculator? I think I wrote it here. Look at the name here. Steno or Nash Markets. Steno is paid. Yeah. So now, what I want us to take from this whole thing is risk management is very, very important. If you don't have risk management, you'd see that you'd make money, you'll not be able to keep it. Do you understand? It's more or less like how in life, if you're making money and then you're spending it the same amount you're making, you'll not be able to keep anything. Do you get? So that's the first thing I want us to understand. Risk management is coming to come and like solve that whole problem. Do you get? So one way you can do it is have a uniform risk. Be risking a certain amount for every trade. So whenever you make money, because of risk to reward, you make more. And whenever you lose money, you're just losing one certain amount and it's uniform across your accounts. Do you guys understand?
Yes, sir.
Now, if you have any questions, you can ask before we call it an evening. And the floor is open. First, it's questions on risk management. Then after that, we'll go to questions on general knowledge.